Hello everyone, we're going to do something a little bit different this week. Basically, I've seen a lot of other channels kind of take on this concept, and a lot of the investment advice they end up giving is terrible. For 90% of people, they really shouldn't worry about which individual stocks they're going to pick because they're just not going to keep up with it. They're going to be focused on jobs and trying to save up and invest for their future and not necessarily digging through 10Ks and things of that nature. So, really quick, if you haven't invested at all and you kind of need a little bit of motivation, I kind of want to pitch something to you. So, basically, I pulled this data, and the average annual savings account rate as of February 27th, 2025 in the US is 0.41%, so less than 1%. Now, the average inflation rates over the past 20 years has been 2.5%. What this means is your savings account isn't even maintaining the same speed as inflation, and so you're actually losing real spending purchasing power, which effectively, to dumb this down, means you are losing money by storing all of your money in a savings account. And again, while it's 0.41% as of this year, this has typically been the case where it is pittance. You receive very, very tiny dividends. Oftentimes, you'll give money to the bank. They'll either lend it out and collect money from that, or they themselves will be investing in bonds, T-bills, and safer securities, and then giving you a very, very tiny fraction of what you could already be investing in. But kind of how I want you guys to look at this is annually take 3% out of everything. So, what do I mean by that? Basically, with your savings account rate, if it is below 3%, and I say 3% because it's fluctuated up till now, it's around the 4% mark, and there have been plenty of times where it's been a bit above the target 2.5%. Basically, if you have things less than that, again, CDs, savings accounts now, I think CDs right now are a bit higher than that, but and even your jobs. I know a lot of companies give 2% annual raises, 1% annual raise. If that's the case, you're effectively getting paid less when it comes to purchasing power for doing the same exact job. So, really, you need to be invested in some capacity or other. Whether you are completely risk adverse to the utmost degree and you just settle for CD rates, or you have a very long time horizon and you keep hearing about how you need to be invested in index funds or mutual funds, and it's just really hard to pick apart. I want to kind of give a bit of a game plan. So, my first priority I would put on is opening up a tax advantaged account, such as a Roth IRA. And again, you can check if your income is under a certain level. They're very lenient on that, so it's a pretty high amount, and most likely it will be. And if your income is well above that, you probably won't be watching this video because you'll already be investing or have real estate or have a job where it doesn't matter and retirement is the least of your worries. But if you're like me and you qualify for a Roth IRA, open that up immediately. Now, prioritize your 401k to the match point. Basically, if a company is offering you a 100% match to a certain point, go ahead, take that. That is free money. You're not going to double your money instantly with investing. You shouldn't try and do that, or you'll really potentially screw yourself over for your future. So prioritize that max. But if you hit that match, come as close to hitting your Roth IRA contributions. They do yearly maxes just because of the power of having tax advantaged investment accounts, especially long term. So try your absolute hardest to reach whatever your category is. I know for over a certain age, there are actual catch-up amounts, which is about 1,000 or so higher than everyone else's cap for what they contribute to their Roth IRA. But really try your hardest to fund that account. Now, in terms of why you want to do that, I like to talk about the power of compounding interest. And basically, this is the equation where 10 plus 10 equals 21. Now, you may not know exactly what I'm talking about, so we'll do a little bit of an example. Basically, let's say you have $10 invested, right? And you get a 10% return. So, just $1. You now have an account with 11 And then let's say you get a 10%. I know this wouldn't happen this even, but just for example's sake, you get an even 10% return the next year, right? You're not going to receive $1 again. Instead, you're taking 10% of your new total of $11. And this is why a lot of people, when they refer to compounding interest, simply it's either in terms of a giant snowball where you push it, it's small, and then becomes bigger and bigger over time, or they'll refer to it as the 10 plus 10 equals 21 or something in that sense. And if you need a little bit more convincing, I highly advise you look up investment calculators. Just plug in some things, look at the overtime return. So say you want to look at 10% yearly, that's about in line with the S&P 500 for like the past 20 years. That's a safe one. And then put whatever time frame you want to retire at, so like 20, 30, 40 years. And what you'll notice is the farther you get along, the bigger those leaps become. And that is straight up the power of compounding interest. Now, the majority of people, advice I've seen on YouTube, it starts talking about you want to do individual research, you want to do all of this, and simply for 90% of the population, you probably shouldn't. I mean, if active management, and these are professionals, they have teams of analysts, on average, they underperform their benchmarks in the 70 to 90%, depending on the year category. And again, those are people who have ridiculous salaries, have teams that all they do all day is research companies, and they either barely get by beating it, like barely as in generating 1% of alpha or so, or they just flat out don't, and they'll charge you hefty fees. A lot of the active management will charge you 1% or higher fees, which is basically getting rid of all of the alpha they were generating, or if they weren't generating alpha or profit above the market, then they're essentially making you lose even more by their fees. So instead, what I would propose to anyone who's not very interested in digging through 10Ks, not interested in coming up with investment theses, isn't going to have that time, has priorities whatsoever, is a very, very simple 3 ETF portfolio where you do 50% of it in VOO, which again tracks the S&P 500. Now, if you're not familiar with the S&P 500, basically the S&P 500 is it's at 503. I know it's not 500. That upsets anyone in finance, believe me. But 500 primarily U.S. large companies, and these will be like the biggest companies on earth, Nvidia, Apple, all of that, and they are weighted specifically by how much their market cap is compared to the rest of the companies. So it makes a lot more sense when you like go to a Vanguard website, type in VOO, you'll see that the primary purpose of VOO is simply tracking the S&P 500, which again is the most commonly used benchmark that all the active managers fail to beat. Well, not all of them. Some of them are genuinely good, but you have to do a lot of research to find them, and with fees they might not be as good. So again, VOO probably about 50%. Honestly, if you really, really just hate looking at things, leave it at 100%. You're not going to do bad having the S&P 500 and tracking that as your primary investment objective. I'll kind of address why the whole entire what happens if the stock market goes to zero argument isn't really relevant in this case. Now, after that, what I want you to do, 25% in either QQQ, or you could do QQM, and basically these track the NASDAQ 100, and the easiest way I can explain this is giving you a lot more exposure to tech. And basically in the past few years, not past few as in like 5, in the past 25, 30 years, a lot of the major gains, even in the S&P 500, have been tech related, but you aren't getting as much exposure to that, and this will make sure you're always gaining exposure to the newest technology without having to find it, without having to gamble on which specific company is going to be better at making these chips or which specific AI company is going to do better. Why not just invest a little bit in all of them? Again, very easy, don't have to think about it. Next, I highly suggest I put 25% just because I'm trying to make this as simple as humanly possible. You can reweight this a bit to whatever you see makes sense, but if you really don't want to do absolutely any research, you just want to simply set your money to work and forget about it, I'd do 25% in an international ETF. For this specific ETF, I ended up picking I ended up going with VIGI, the Vanguard International Dividend Appreciation ETF, and you can really, I suggest, go to Morningstar, find any international ETF that is 5 stars that gives you a really broad base. But why I specifically picked the dividend appreciation one is because companies that can appreciate their dividend, it's a very large green flag because it basically that company commits to providing a dividend and to raising a dividend, and they're not likely to cut said dividend, which they have to be doing well in order to make that commitment. And so that's why I like that. And really simply what I would do, if you have a long time frame, reinvest, select yes for absolutely all of them, especially if you're going to be looking at anything over a decade, somewhere in the 2 decade category. You want to be reinvesting your dividends on all of them. We'll get to the point when you do retire, you don't necessarily have to do it, and I'll go a little bit more in depth as to why, but especially in the earlier part when you're all about appreciation in your capital, you don't have enough to really preserve, and on the investor life cycle, you're really into trying to make gains. Reinvestments are a huge key part in that. Now, what I would do that makes this very, very simple is pick a certain percentage of either your paycheck every 2 weeks or whatever, whenever you get that you're going to spend in your Roth IRA. Or you could set it up monthly, so you could look at, okay, I want to commit this much each month to make sure I'm hitting the maximum contributions in my Roth IRA, and simply just allocate it to those 3 ETFs I mentioned, with a 50% going to VOO and then splitting up 25% and 25% to the others, and you will be set for the long run. Now, if you want to take this one step further in complexity that could potentially help you in the future, especially if there's a bad year, which again, you're going to face bad years. Everybody's faced bad years. If you need any level of help holding on and not panic selling, go to the VOO or go to the S&P 500 right on Yahoo Finance, click it, and click max time frame up and to the right. That includes all the bad financial crises, that includes 2008, that includes COVID. Zone out all of the bad stuff, just hold on to it. The economy isn't going to increase. It is going to continue to increase. There are a lot of factors in that. Maybe I'll make more of a video on that later if this gets any attention. But back to the main purpose, if you want to add a little bit of complexity that could potentially earn you a slightly higher return, wait until bad days, or if you're in a bad year, you can not necessarily try and time the bottom, but wait a couple weeks if there's some big news going on or if things look really bleak, and then lump sum all of that you've saved up. Maybe it's a couple months. Maybe you really want to commit to making a large investment during a bad year while everything's cheap, and then lump summing in that case will make sense. But again, you don't necessarily have to add that complexity. You can make it as simple as you want. Really, the important thing is just, please, for the love of God, do not put your investments in your savings account and think you are fine. Inflation is eating away any effort you are making to add money to it. You're not making money when you account for inflation. You are actively losing money. And by even investing in VOO, or which is basically just tracking the S&P 500, you are setting yourself up for the future. You might be able to retire early, and you're going to have a much better retirement. Oh, I did promise I'd talk to why you can turn off reinvesting dividends, and that is because when you hit your retirement age, whatever that is, you can actually get the dividend. So I'll just say 3% in this instance. And let's say you've maxed out your Roth contributions for decades, you've had your compounding interest, you'd basically be getting 3% of your 1.5 million, and then it would increase probably around 10%. We use 10% in easy terms because, again, 10% is the average return of the S&P 500 over the past 20 or so years. And every year you're getting an increased amount that you can just use as spending money. It's like having a salary at that point. There's going to be a point where you will make significantly more money investing than you would have in your career at that point, especially if you do the things, again, start early as possible and look at an investment calculator as to why the longer you're able to invest, the better your results are, the better the power of compounding is in your favor. And if you're not going to keep up with companies, don't invest in single companies. There's no need. Active investors, that's like primarily what they do. The managers, that's what they do. And they underperform markets. Why should you? You don't need to add any complexity. Investing can be as simple as you want it, and you can make a good amount of money doing that. So again, thank you very much, and I hope that you learned something.